Hope I find you all well today, as it is Tuesday, the 31st of October, coming to the end of the month, and hopefully you had a profitable month. If not, doesn't really matter. What is a month? A month is just a terms of meaning. Go work tomorrow, put it in. Doesn't matter if it's the 1st or the 31st. No difference at all. With that being said, I'm gonna expand further on a concept that I had just provided to you guys on my YouTube channel, Why Trade, and that is key levels. And you can see right now we have the Nasdaq 100 E-mini futures on the chart, and we are at the 4-hour time frame, and we're gonna plot our key levels again so that you see a live example of how I would do it during market hours, because these are currently market hours in my time. You can see the time is 14:06 in Europe, and that is currently the New York session as we speak. So we'll just get straight into the video, straight into the content. And this is not going to be a strategy breakdown, but usually what I would do is I would want to look at my higher time frames for a bias as to which direction the market is actually moving in. And if I'm going to take a trade that day, I want to see all of the time frames, all of the candlesticks on the time frames in line, in the same color, moving in the same direction. If one time frame is out of line or out of sync with the rest of them, then I will not trade on the higher time frames. Only when it is on the higher time frames. On the lower time frames, I'm a little less strict, and I'm more willing to accept that there may be a bullish candle when markets are selling, and there may be a bearish candle when markets are rising. So I look at all of my time frames. I look at my 1 month, I see it's bearish. I see my weekly, it's bullish. Like that today, no trade for me. However, for the purpose of this video, we're going to continue along so that we can just identify our key levels. So we would see that our weekly is bullish, our daily is bullish, and our 4-hour is the time frame that I'm now going to come and identify my key levels. Now, because of the fact that all of the candlesticks are not in line, I would not take this trade because I'm not really sure which direction it is going in. It could be a pullback for it to move in the direction that it was always going in, which is bearish according to the trend. If you're someone who uses trend lines, you can see as we plot over here that the markets have been moving down against this trend. And I am not a trend line trader, but I can just acknowledge that this is what the current trend is. Now, with that being said, for us to now go and plot our key levels, even though we don't really understand the direction, we'll look at the 1 month and we can see that we're bearish. So we'll just say that we're bearish. On the weekly, daily, we're just pulling back. So we are looking for sales in this current moment. We are looking for price to go down. So we're looking for sales in this current moment. That is what we're trying to identify. And as you can see, it's 1 hour 16 minutes until the candle closes. So far, as we look at price right now, we cannot tell which way it is going, whether this candle is going to close bearish or bullish because of the way that the candle is forming. It's forming somewhat a dragonfly hammerhead pattern, which is usually a reversal pattern. However, that is of no use to us in this moment. All we want to do is to identify the key levels and identify the places where we can take our trades from. So because we're in a bearish market, I will identify this as resistance, and that will be my first key level. So this will be the first key level. And then now we're going to look for the next key level as to where we think that price is going to go, because this is a bearish market. Now, according to this will now be my next key level. And as you can see, markets are going up and down. However, this is the range, and this range is where I'm going to be looking for my trade. So over here, within this range, right here, against these key levels, these are the areas that I will be looking for trades to see if the trades are going to go up or down. So the options are now here. Either we're going to go up or we're going to go down into the sun. And from here, I'll go down to my lower time frames, look for my patterns, look for my confirmations, and then take the trade. However, you can see it is not difficult for you to identify your key levels. It's literally the most recent resistance. And then most of the times, if I was to have my key levels, even though the market is not giving us a strong bias in the direction, because as I told you, one of the candles is, no, the daily candles are all bullish. So clearly it is moving up in this moment, but when you look over the long term, it could be moving up just so it can move back down. So in most cases, what I would actually like is to have a target to say that price is gonna close below this point. I'll just put an arrow so that you guys can see. I'll put a sticker. Price is gonna close below this point and eventually come down to this point. And this will give me a very good potential trade that will have a favorable risk to reward, because my risk usually 10 pips and then the reward is usually more than 1 to 4, 1 to 5, 1 to 6, 1 to 7, 1 to 8, 1 to 9. I don't go for 1-to-1s, and usually I would go for a 1-to-1, to be honest, if my trading plan gives me a 1-to-1. However, on most days it will not give me a 1-to-1 because of the concept of key levels. It gives me a wider range and therefore more potential for profit when you make these trades, because you can see that it's given us a large area for us to see where price will potentially go. So from here, this will usually be the first target. However, I will not close my trade here, but this will usually be the first target right here at this point in time. We'll be anticipating that price will bounce off of this key level here, close below here, and continue down to here. And that is how it will go. Now, when you go and start researching about key levels, you're going to hear so many things about breakout key levels. This is a resistance key level, this is a that key level. At the end of the day, what you need to understand is that a key level is a key level. All the other lingo and terminology that comes with it is honestly irrelevant to you. All you need to know is where the key levels are at. Whether it's a breakout or whatever, it doesn't really concern you. What concerns you is that you have mapped out correctly the key levels, because you'll see that price more often than not is going to bounce off of these psychological levels. Because at the end of the day, you need to understand that these psychological levels are not concrete. It's not like there's an actual wall or block like what we have here that is stopping price from going past that point. There isn't. Price is free to do whatever price is going to do. However, more often than not, because of understanding human psychology, human behavior, and human patterns, we can assess that at this point, more likely than not, in conjunction with the fact that we have multiple wick rejections right over here, meaning price was failing to close past this point. We have multiple wick rejections, meaning price was failing to close past this point, and price was bullish. However, eventually a red candle came to create a resistance. When we have that understanding and that knowledge, we can make better trading decisions, even though none of this is concrete, as I said, because this is all invisible. These are all things happening within people's minds and not actually happening on the charts. Eventually, it transmutes into the chart, but the chart is not determining all of this. What is determining this point as a key level and this point as a key level is the people, the market, not the chart, not the lines on the chart. So you always have to have that in mind, that you need to look past the lines on the chart and realize that you're dealing in a market that has a lot of people. And because of that, you have to understand that when you plot your key levels and when you make your trading decisions based off of those key levels, nothing is concrete. But more often than not, because of taking time to understand human behavior, human psychology, human patterns, humans are habitual creatures. More often than not, where you plot your key levels, you actually see that that is the point where price starts to reject. And you can see how we have a bullish candle that's coming up. And what is happening to the bullish candle? I need a pointer. But what is happening to the bullish candle? To this exact bullish candle here. What is happening to that bullish? It's rejecting this zone. It's rejecting it. It's failing to push past that because this is built resistance. And that is why this is the first key level. And because it's failing to push past this point, automatically, price can only go one of three ways. It can only go up, it can go down, or it's going to go sideways. It's either it's going to be bullish, it's going to be bearish, or it's consolidating. Simple as that. So because price is failing to go past this point, we are left with two options, meaning that this cannot be an opportunity to buy. This can only be an opportunity to sell or to stay out of the market. And what we're going to use to identify whether we're going to stay out of the market or we're going to sell will now be volume and our patterns. With volume, it comes down to what time are you trading and the movement of the candles. And then with Oh my gosh, I just lost my train of thought, guys. Sorry. I just lost my train of thought. And then with volume and fuck my life. So we have one of two options. Either price is gonna consolidate, and if you see price consolidating, meaning it's moving up and down, it's moving up and down, it's not giving us much cause for concern to the fact that it might move down, because price is moving up and down. We will stay out of the market. So I'll show you what that would look like once I find the correct tool. So this is what it would look like if price is consolidating. So it's going up, down, up, and down. And therefore, when that is happening, we're going to stay out of the market. However, if we confirm with volume and our patterns as to where the market is going, then at that point we can make a decision based off of the volume and the pattern to sell the market, and would open up our position and then from there we determine our risk. Told you I'm a 10 pip guy. We put our 10 pips, and then our target is this key level. So more or less this will be how we would trade the situation using key levels. And that is just a short example that I could give you guys to elaborate on the video that I posted before, so that you understand in depth what is actually happening when you are looking at key levels. With that being said, like, comment, and subscribe if you feel like it.